I mean, it's yet another week, yet another roller coaster ride in Trump's trade rhetoric. I mean, we only have to go back a couple of days and it was a sea of red across global markets as Trump announced he was going to be taxing France and that there would be no resolution to the trade war with China for at least another 12 months, even post-US election. Today, things are looking more sanguine. I think in terms of investor impact, it's really interesting where in the world you are. Certainly in the West, a lot more emphasis seems to be put on Trump's rhetoric. It's much more of an understanding when we talk to our own investors here in the UK and across Europe that actually it's Asia that feels the brunt of this. And I was in Asia in October and actually they have the opposite feeling. They say actually they'll be absolutely fine. There's far more drivers of growth there in Asia and of stock markets, incredibly supportive demographics for one. And actually they say that Trump is only hurting himself with this continued rhetoric.
And yet, there seems to be a very high correlation between global growth numbers and global trade. We continue to see trade volumes fall off a cliff this year. Global growth indeed getting impacted as well, and we see that in the manufacturing numbers. But there's also a big disparity between what's been happening on the growth side of things and asset classes. You have major stock indices up north of 20% this year. Can that continue into 2020 if the growth backdrop isn't supportive?
I think you're right. You know, if we have a look over historically, the correlation between global trade and global growth, going back a few years, you can see both completely drop off. And there have been warnings in the last 24 hours, indeed from the IMF, about the impact of continued trade wars and what that will do to the global economy. In the past, or Investing 101, we always say the stock market is not economics, but actually increasingly there is a correlation between those two as well. You only have to look at the last 3 months of last year where we saw increased concerns about recession, global markets across the board fell, and indeed asset classes, even oil prices fell. Remember, we bottomed out on Christmas Day last year. So increasingly the three things do go hand in hand: trade, economic growth and stock markets. And at the very least, if they don't all fall together, they do have increased volatility together.
Emma, can I add another leg to that stool you've kind of outlined there? And it's the idea around the US consumer being so resilient over the last 12 months. With all of these trade wars, potential trade wars, trade salvos from the US administration, what do you think it would take for that consumer confidence in the US to start to drop?
Well, we saw the deficit fall in the US, and part of that was down to weaker import, which potentially suggests there is a weaker US consumer. However, oh, sorry, can you hear me? The sound's just gone from my ear.
Yeah. No, Emma, we've still got you.
Yeah. However, it's a bit conflicted, basically. We had Walmart coming out last month saying the US consumer is extremely strong. Although we're expecting US jobs figures to be a little weaker today, the unemployment rate is still extremely low. But there are just signs at the edges that the US consumer is a little less confident and that sentiment may be drifting, although from a pretty solid base.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.